Well, hello, I'm Earl Dimbath, your conch economist, and it's been quite a week. We started off with reports on unemployment, and it looked like the unemployment rate was higher than it's been in several years. Then, at midweek, we got a uh, message from the President of the United States recalling his first year in office and outlining his accomplishments and making promises about lower inflation in the future, particularly in the areas of medical care and so forth. And the following morning, when the CPI came in lower than expected, and through all of this, the stock market went up and down. With a higher unemployment rate, the market fell, and with the lower inflation rate, the market went up. And so it's been quite a week. And the problem is, there was a lot of doubts about the accuracy of the data. Could we really believe the unemployment rate? Could we really believe the inflation rate, specifically with reference to the background of the collecting of the data and when it took place and the problems of the government shutdown and so forth? But there is one clear event that is unfolding, and I don't know that it's been given very much attention to, but for a long time, of course, the Fed has been giving lip service to a 2% inflation rate. They are a long way from that, at least as far as the official data are concerned. But in addition, they've decided recently to begin lowering inflation rates and lowering discount rates, and we've talked about that. For a long time, the Fed's interest rate policy, was such that the rates were too low to fight inflation, but they were too high to help homeowners and the construction industry and so forth. So what is emerging apparently is that the Fed gives lip service to fighting inflation, but really they're going to be concentrating more on looking after maybe the employment aspect of it, or the construction, housing, and the administration has taken on major responsibility with reference to inflation. This past week, President Trump met with executives from the pharmaceutical industry, working out a way to get medical prices lower. There's also conversations with insurance executives with reference to trying to get the cost of insurance lower. So apparently, the executive branch of the government is going to be more focused on trying to fight inflation. And the Fed, for whatever it can do through lower interest rates, will try to maybe help out housing. But nonetheless, it was quite a week, not unexpected. We were anticipating a lot of data, and we got it, and with mixed reviews. So let's look at some of the data and see what has actually happened. And we're going to be taking a look here at the bond market. There's an old adage on Wall Street that the smart money is the bond money. So if that is true, let's take a look and see, what did bonds do, what did interest rates do, and what can they possibly tell us. Looking at the table, we can see that the Fed funds and discount rates, of course, are stabilized now at 3.64% and discount rate 3.75%. Those are fixed by the Federal Reserve. Those are short term overnight rates. But it's from that point on that the yield curve gets influenced by market forces. The 1 month, of course, is greatly influenced by the short term Fed's rate. And there was some slight decline here from 3.67 to 3.19, not much. And we can see the same thing there with the 3 month and 6 month. The 1 year wasn't changed all that much. Despite all the hoopla of the week, interest rates remained largely intact. A little bit of softness here on the 1 year from 3.5 to 3.53 to 3.514. Moving on down the curve, take a look at the 5 year. We did see virtually no change there. It's a slight decline, 3.74 to 3.69. The critical one here is the 10-year bond, because it has a great influence on mortgage rates. And we saw that almost unchanged from 4.19 to, say, roughly 4.15. Even the long-term bond there, the 30-year, a slight decline, but not a whole lot, 4.85, 4.827. So after all was said and done, we didn't really see much in the way of a change in the interest rate structure. Very, very similar to the week before. I've got to graph here that'll illustrate that in a better form. Okay, here's a graph of the yield curve this week versus the week ending 12/12, the 2 Fridays. The plots are as of the close of trading on Friday. And as we can see, there's still kind of the fishhook shape, a little bit of deviation, but for all practical purposes, the yield curve looks very much the same for this last Friday's close at 12/19 as it did the previous week of 12/12. Interest rates influence a broad range of activities in the economy. We mentioned previously the impact of the 10-year bond on the 30-year mortgage rates. I'm recalling here the 10-year rate, and as we saw earlier, it did decline ever so slightly from 4.19 to about 4.15, but that was enough to help influence the mortgage rate. It didn't fall by much, but the 30-year fixed as of Friday's close was at 6.21%, down a little bit from 6.28 the week before. Not much of a move, but at least a move in the right direction. Interest rates influence foreign currencies, and we've been looking at the euro, and the price of the euro went up after the Fed lowered rates, which was not to be unexpected. But we have seen a little bit of softening since then. A week ago, it took a dollar 0.174 to buy a euro. Now it's down to just about 1.17, 17.08. I've included here the Japanese yen. The Japanese yen is very important because, number one, they are a big trading partner of the United States. Number two, they are a big holder of U.S. debt. And number three, they have been raising their own interest rates recently. And for a variety of reasons, the exchange rate expression between the U.S. dollar and the Japanese yen is not the same as it is with the euro. Always, it's somewhat reversed. When we look at the euro, we look at $1 versus, 1 euro versus how many dollars. But with the Japanese yen, it's $1 versus how many yen. And so we can see that 1 US dollar a week ago was 155.81 yen. It's now 157.75 yen. So if you were in Japan, you were having to pay more to buy a dollar than you were a week before, which would indicate some strengthening of the dollar, despite the fact that interest rates were, for all practical purposes, virtually unchanged. I've said in previous programs that one of the cures for the problem of affordability or high inflation is an increase in wages, specifically an increase in real wages. Now, real wages are wages above and beyond inflation. And the good news this past week was that the Bureau of Labor Statistics issued a release that shows that from the period November 2024 to November 2025, real wages did increase. Average hourly earnings in the United States did increase by 0.8%. The nominal rate, which would include inflation, was 3.75%, 3.5%. Inflation was 2.7%, so this gave us a real increase of 0.8. Modest to be sure, but it's in the right direction. So hopefully we can see this continue into the coming year. Well, on balance, the events of the past week do present an optimistic point of view. Even if the data were not of the quality we would like or as accurate as we would like, the available data do indicate that there is some progress being made on inflation, and there is progress being made with reference to lower interest rates and specifically mortgage rates. So looking ahead, it appears as though the Fed is going to be taking on more responsibility for trying to lower interest rates, lower mortgage rates, and by extension, maybe help the labor market. And it's clear that the executive branch of the government is certainly taking on a major responsibility to try to control inflation, to bring some costs down, particularly in the areas of pharmaceuticals and insurance. The president was very direct and forceful on this, and obviously we certainly wish him every success because we could all benefit from that. The next 2 weeks are going to be shortened weeks in terms of active trading on the markets because of the holidays. So it's a good time to wish you a happy holiday and a great new year. I will be presenting a program a week from now, and we'll try to get a better view of some of the forces that will be influencing economic activity in 2026. So for now, this is Merle Dimbath, your conch economist, wishing you happy holidays.